It's Sunday morning. You pull into the bank. You want cash, not a wire, not an available balance. Cash. The doors are locked, lights on, people inside, but the ATM screen is black. No error message, just black. And on your phone, a notification hits. 3 words. Temporary restrictions. That's the phrase they use when the system is choking. Not when you're protected, not when you're safe, when it's choking. Now listen closely, because the switch that can trigger that moment is not in Washington. It's not even on Wall Street. It's in Tokyo, Japan. The country the sleeping herd still thinks is low rates forever. The country they call stable, safe, boring. That's the lie. Japan's bond market is the hidden power line for the entire modern casino. And that power line just started sparking. If you've been watching silver lately, you've felt it. That odd tense movement. That feeling that something is pushing from underneath. Like an earthquake you don't hear yet. But the glass on the shelf starts to tremble. This is that tremble. For years, the Bank of Japan was the world's quiet sponsor. It pumped cheap yen into the global system. Cheap funding, cheap leverage, cheap free money. And what did the system do with that cheap money? They didn't build factories. They didn't repair bridges. They didn't secure your retirement. They gambled. They bought tech. They bought treasuries. They bought everything. Except honesty. They turned your working life into chips on a felt table. And the dealer was smiling, but now the cost of that cheap yen is rising fast. Japan's yields are spiking. And when Japan's yields spike, global leverage snaps like dry wood. This is why silver is moving. Not because of a headline, not because of a trend, because a hidden switch just flipped. And the people who run the system know it. They're repositioning, quietly. While the sleeping herd argues about politics and football. You don't need to be a trader to understand this. You just need to see the trap. Because when Japan's bond market breaks, your safe world turns into a lifeboat problem. And silver? Silver becomes the lifeboat ticket. Here's what they won't say out loud. Bonds are not boring. Bonds are the heartbeat. A bond yield is the price of money. It's the rent you pay to borrow time. And when the rent spikes, everything downstream gets squeezed. Your mortgage, your car payment, your city's budget, your pension, your bank. For a long time, Japan was the planet's cheapest credit card. Borrow in yen at near zero, convert to dollars, buy higher yield stuff, repeat, leverage it, wrap it in a suit. Call it prudence. Call it risk management. Call it institutional. That trade has a name, the yen carry trade. And it wasn't small. It wasn't a hobby. It was a structural pillar. It fed U.S. stocks. It fed U.S. bonds. It fed every risk asset that needed a steady drip of cheap funding. It was an IV line, slow, constant, invisible. But every carry trade has one fatal weakness. It only works when rates stay low and volatility stays calm. And both are changing. Step 1. Japan ended the negative rates forever era. In March 2024, the Bank of Japan moved away from the old framework. Negative rates and yield curve control. That was the first crack in the dam. Most people heard it and shrugged, because the sleeping herd thinks central banks are gods, but central banks are not gods. They are managers, and managers panic when the math stops working. Step 2. Rates started climbing. In December 2025, the BOJ pushed its policy rate to zero. 75%. Japan hadn't seen that kind of level since the mid-1990s. To an American, that sounds tiny. 0.75%? Who cares? A retiree understands this better than a trader. When you've lived long enough, you know the danger is not the number. It's the direction. Direction is destiny. Japan is a nation built on the assumption that rates never rise. Mortgages, pensions, government budgets, all of it. A house of cards that only stands because the wind stayed still. Step 3. The bond market stopped believing the story. In January 2026, Japan's 10-year government bond yield surged to around 26%, a level not seen since 1999, and the ultra-long end went wild. Japan's 40-year yield jumped over 4%. Let that sink in. A country built on near-zero yield skirting is suddenly paying real yields again. That changes everything, because Japan is not a small player. Japan is one of the largest pools of savings on Earth. Japanese institutions own massive stacks of foreign assets. U.S. treasuries, corporate bonds, global equities. They are the quiet whale, the kind that doesn't splash until it turns. And when yields rise at home, those institutions start pulling money back. Repatriation, sell overseas, buy domestic. That's not a theory. That's what they do to survive. Now add politics, the most dangerous fuel of all. A snap election was called for February 8th, 2026, and Japan's prime minister floated a 2-year suspension of the 8% consumption tax on food, estimated around $1.5 trillion. Think about that. A tax holiday paid for with more debt. It's like a man drowning who decides the solution is a heavier coat, warm, comforting, and fatal. So bond buyers demand a higher yield because they smell the smoke. And when yields rise, bonds fall. That's basic. But most people don't feel it until it hits the things they trust. Pensions hold bonds. Insurance companies hold bonds. Banks hold bonds. Retirement systems hold bonds. Bond losses don't look like a stock crash. They look like rebalancing. They look like adjusted projections. They look like updated assumptions. They look like a letter in the mail. Then, one day, your lifestyle changes. Now watch the chain reaction. This is where the hidden switch lives. Rising Japanese yields hit portfolios. Those portfolios are leveraged, so the managers sell what they can sell fast. What's liquid? U.S. stocks, U.S. bonds. Japan sells. U.S. yields jump. Markets wobble. Then the risk-free story dies. And when the risk-free story dies, the public discovers what counterparty risk really means. This isn't some academic concept. It's a simple question. Who owes you your money, and what happens if they can't pay? Now we do the math they never do on TV. Japan's debt load is around 230% of its GDP. 230%. Imagine you make $100,000 a year, and you owe $230,000. Now imagine your interest rate goes from almost nothing to 2%. That's $4,600 a year in interest on the same $100,000 income every year. Before the principal, before anything else, that's the math of a debt trap. And Japan's trap is decades old. Decades of promises, decades of stimulus, decades of temporary emergency measures. That never ended. They call it the lost decades. But it wasn't lost. It was borrowed. Borrowed from the future. Now the future is billing them. Now do the same logic for the United States. As of early January 2026, USA's gross national debt was about $38, $43 trillion. Now imagine average interest costs rise by just 1%. 1%? That's it. $38. $43 trillion times zero. Though 1 equals about $384 billion every year. A permanent new bill, bigger than many government departments, just to service old debt, not to improve your life, not to protect your savings, just to keep the Titanic's engines running. And that's the clean math. The dirty math is worse, because rates don't rise in isolation. They rise when trust is falling. This isn't a theory. This is math. Now they point to the safety nets. They always do. FDIC insurance sounds comforting. $250,000 per depositor, per bank, per ownership category. But FDIC is not a magic wand. FDIC doesn't print gold. FDIC doesn't mine silver. FDIC operates in a world where the government must fund the backstop. And the government backstop is funded by debt. So when yields spike, the cost of that backstop spikes. And when the cost spikes, the rules change quietly, suddenly, over a weekend. If you think that can't happen, you haven't studied history. In 1933, Americans learned a hard lesson about rules. In 1971, the world learned another. Promises are only promises until the math breaks. Then they become paperwork. Japan is not just another country. Japan is the pressure valve, and the valve is rattling. Now we talk about what they will do, not what they say, what they do. When the bond market revolts, governments don't admit failure. They redesign the cage. They create new rules, new terms, new temporary measures that never end. And the trap is always the same. They want control over your money, because control is the only way to manage a debt system that can't be paid honestly. So you'll hear more talk about digital solutions, modernization, stability. Nice words, but the real word is control. A digital currency, a programmable dollar, a system where your money works only when they allow it. The pitch will be sweet. It stops fraud. It speeds payments. It helps the poor. It keeps us safe. And the sleeping herd will clap. Because the sleeping herd thinks convenience is freedom. It isn't. Convenience is a leash. And the moment the bond market breaks, emergency becomes permanent. Imagine this. The bond sell-off deepens. Banks quietly tighten. You go to withdraw 10 grand. They ask why. You laugh. Then you realize they're not joking. Imagine this. You sell a few shares for extra cash, but settlement takes longer. Delays. Enhanced security. Translation, they're buying time. Imagine this. Your pension fund announces a temporary adjustment to cost of living increases because their bond portfolio took a hit, because yields spiked, because Japan pulled the switch. Imagine this. Your health insurance premium jumps, your groceries jump, your property taxes jump, but your income stays flat. That's how inflation kills, not with drama, with daily erosion. Imagine this. They roll out new limits on speculative purchases, fuel, ammo, metals, volatile goods. They don't ban it, they just make it hard. Paperwork, waiting periods, reporting, little walls that slowly become a prison. Then, one day, your payment is reviewed. Imagine this. They announce capital controls for your own good. You can't move money out of certain accounts without permission. You can't transfer above a threshold without a reason code. You can't buy certain products because they are too risky. And the sleeping herd will clap because they're trained to worship the word stability. But you and I know stability in a debt crisis is a costume. Now bring it back to Japan. Japan is showing the world what happens when the bond market refuses to play along. Yields rise, funding costs rise, and politicians respond the only way they know how. Spend more, promise more, borrow more. That's how empires end, not with a bang, with a spreadsheet. And when the spreadsheet no longer balances, they take it from the citizen, not always by force, sometimes by inflation, sometimes by taxes, sometimes by rules that just happen to trap your money. This is where silver enters the story, because when confidence cracks, people don't run into paper. They run into what doesn't need permission. And silver is permissionless. No login, no approval, no counterparty, no bank holiday. Just weight, just metal, just reality. That's why silver moves hardest in the late stage. Because it's small, because it's emotional, because it's the lifeboat people notice after the Titanic hits. And here's the cruel part. They always tell you it's contained. It's overseas. It won't affect your town. And that's what they said in 2008 until it was on your street. Japan is not overseas anymore. It's inside your interest rates. It's inside your mortgage. It's inside your grocery bill. Now we get to the exit. And I want you to hear this like a warning, not a slogan. Gold and silver are not investments right now. They are exits. They are survival, freedom, bearer assets. Because in a world where rules can change overnight, bearer assets are the difference between I own it and I have a claim. Most people don't understand that. They think an ETF is metal. They think a bank statement is money. They think insured means safe. But the system is built on claims. A claim is a promise, and promises fail when the math fails. Physical metal is different. Physical metal has no CEO, no board meeting, no bailout, no terms of service. It just sits there, patient, silent, heavy. History loves heavy things, because heavy things are hard to fake. Now, why silver specifically in this Japan story? Because silver is the pressure gauge. Gold is the big ship. Silver is the speedboat. When the system tilts, gold moves first. When panic spreads, silver accelerates. Because silver is smaller, less liquid, more volatile. That's a polite word. The real word is explosive. And the BOJ yield spike is gasoline. Here's the hidden switch in plain language. When Japan's yields rise, the carry trade unwinds. When the carry trade unwinds, leverage positions get forced out. Forced selling hits stocks and bonds. Bond yields jump, currencies swing, and central banks face a choice. Raise rates and break everything, or print and pretend. History tells you what they choose. They print, they inflate, they dilute. They call it support. You call it what it is, theft, slow theft, but theft. That's why being your own central bank matters. Being your own central bank means you hold an asset that is not someone else's liability. No counterparty risk. Counterparty risk is simple. If you need someone else to perform, to deliver, to pay, then you have risk. If your retirement depends on institutions staying solvent, you have counterparty risk. If your savings depend on government promises, you have counterparty risk. If your money can be frozen with a keystroke, you have counterparty risk. Physical silver and gold reduce that risk. Not perfectly, but radically. They move you from permission to possession. Now, I'm not telling you to panic. I'm telling you to prepare. Because the people at the top are preparing. They see Japan's bond market flashing red. They see 10-year yields above 2%. They see 40-year yields over 4%. They see politics pushing more deficits. They see the carry trade wobbling. So they hedge. They buy real assets. They position quietly. They do it before the crowd. Because the crowd pays the highest price. You don't have to be the crowd. You just have to be awake. And let's be honest. Most retirees don't need maximum returns. They need durability. They need something that doesn't depend on a press conference. When you hold physical metal, you hold optionality. Optionality means this. If the system works, fine. You still have metal. If the system breaks, you still have metal. No password reset required. Before we end, you need one more distinction. Paper metal and real metal. Paper metal is a promise, a line item, a share. A claim you hope someone honors when everyone wants out at the same time. Real metal is what you can hold, what you can trade, what you can pass to your kids without asking permission. In calm times, those look similar. That's the trick. In storm times, they split apart, like wood in a fire. And that split is what creates the violent moves in silver. Because silver is a small market, tiny compared to government bonds, tiny compared to stock indexes. So when big money tries to crowd into a small door, prices don't walk, they jump. That's why in every monetary panic, silver becomes emotional. It's the metal of the late realizer, the person who didn't act at 30 or 40 or 50. And then at 65, they finally feel the floor tilt. That person doesn't buy a little, they buy fast. And when millions try to buy fast, you get shortages, premiums, delays, back orders. And then the worst phrase in finance, cash settlement. Because cash settlement is what they offer when they can't deliver the real thing. It's a lifeboat made of paper. So don't overthink this. You don't need a PhD, you need a plan. Slow and steady, convert a portion of paper promises into something outside the promises. Not because you hate the system, because the system is cornered. Cornered systems bite. And here's the history lesson most channels won't say out loud. When governments can't pay honestly, they pay politically. They pick winners. They pick losers. They change the rules. You cannot vote your way out of math, but you can position your savings around it. That's what physical gold and silver do. They don't fix the Titanic, they give you a lifeboat. If you want to survive what's coming, subscribe to Economy Meets History, not for entertainment, for warning, for timing, for truth. Because the sleeping herd will not help you, the corrupt system will not save you, and the people who built this casino will not refund your chips. One last thought. Japan's yields are not a Japan problem, they are a signal flare. When the cheapest credit card on earth starts charging interest, the whole world feels it. And when the whole world feels it, paper promises start burning. You can watch it happen, or you can hold something that can't be printed. Choose wisely.